Right, well, welcome to this week's video, and it's a very interesting video in many ways because we've reached a very important point in the markets. And whether you're trading currencies or commodities or stocks or metals, we're at a pretty interesting point. So what I want to do, and this is going to be a little bit higgledy-piggledy in a way, but I'm going to try and go through various things and relate this to the technicals on the chart, and then also look at the news that's come out and the news that's going to come out in the coming week. So first of all, let's cover the news. On Friday, we had the news that came out regarding the inflation rates in the US, which increased. I think it was 8.6 or 8.8%, the CPI number, which is up from the previous number, and it's something like a 40-year high. So inflation is a big problem. And that's been caused by a variety of different things, including grain problems from Ukraine, oil and gas, also related to Ukraine and other things, and various pipeline projects and that sort of thing. But across a variety of spectrums, the consumer price index, or the cost of living inflation rate, has increased to pretty unprecedented levels. And as a result of that, the dollar strengthened and the markets weakened overall. Coming up next week on Wednesday is the FOMC, the Fed's interest rate announcement, which we expect will be 50 basis points, but it could actually even be higher given the surprise increase in the inflation rate. So I think 50 basis points is already priced in, but it could be higher. It could be 0.75, which would really throw the cat amongst the pigeons. And if that does happen, if there is bad news on the interest rate side of things, that's going to be good for the dollar. Dollar will strengthen and the markets will continue to weaken. Let's have a look at the markets very briefly. So here we've got the NASDAQ. Now, my position on the NASDAQ is long until we break beneath these lows, and then I think we'll drop lower. And what we've done is, with that move lower on Friday, that's this one here, we've moved down to this level, which is pretty close to the recent lows. And if I put a fib retracement in, this becomes quite interesting, because you can see we've reached the 78.6% fib retracement of this market recovery that we've had recently. When I say market recovery, some might call it a dead cat bounce or just a small correction. We only got back up to previous support, which is now resistance. We hovered around there for a while in a very tight range with something that looks like a head and shoulders pattern. If you look on the hourly chart, you'll see that this is a pretty classic head and shoulders. There's the left-hand shoulder, there's the head, right-hand shoulder, and the pattern has now been completed with this move down to the expected levels brought about by this head and shoulders pattern. But we are at the 78.6% Fibonacci. We're near the recent lows, or the yearly lows, and my position on the NASDAQ is long until we break beneath this low here at around about 11,450, thereabouts. I think slightly higher than that, actually. So call it 11,500. So I've already entered a long position just around about here, and I'm prepared to hold on to that until we break beneath there. So that's the NASDAQ. If we do manage to bounce off here and rally, then I expect we'll retest these highs and we'll move up to some of these higher up resistance levels. And perhaps we've got a market bottom in place. There's a lot of confusion about it in the market at the moment. You'll see a lot of commentaries from various traders saying this is a bottom. You'll see a lot of traders saying this is not the bottom, we're due for a lot more pain, and that the market is likely to drop much further. Now, I've got some support levels further down. These, the blue and the purple, or pink and green, these are all the Fibonacci support levels. So you can see where those are. So we've got this one here at about 9,000. We've got one at about 10,000, which was the previous all-time high. That's a very significant level. Could be that we drop as far as that, or perhaps down to this level here, where you can see we had this pullback in 2020. So those would be the levels that we would be looking for further buying opportunities if we break beneath this current low. But as it stands at the moment, on a shorter term basis, we're still above this year's lows. We're still above the 78.6% retracement. We're still above the bodies of these candles here. You can see we've got some wicks. During this bottoming process, we formed quite a number of wicks, and we're actually at the bottom near where these bodies ended. So I don't know. I think it's very difficult to say. And a lot depends on the news that comes out on Wednesday. So if the interest rates increase by more than 0.5%, we're definitely going to break lower. If the interest rates come out at 0.5% and the comments by the Fed indicate that they may be just continuing along the process that they've already mapped out, which is 0.5% now, and a few more similar increases towards until around about the end of the year, then we might see a bounce. If it's much more bearish, much more hawkish from the Fed, then we could see this market begin to move down. Now, that's the NASDAQ in isolation. If you look at the S&P along with that, and this is probably the most important one, let me just get rid of that. Very similar situation. We're at the bottoms of these bodies, above these wicks, a retracement down to, I think this is a 61.8% retracement. It's also a significant Fibonacci level. And no, it's exactly the 78.6 as well. So you can see we just touched that 78.6 and we bounced up very, very slightly on the close on Friday. Now, the 78.6% Fibonacci level for me is one of the most important. It's the extremity of any retracements. And if there is going to be a reversal of any significance, sometimes and quite often, actually, it does happen at this particular Fibonacci level. This one happens to coincide with the bottoms of these candle bodies when we formed the support above these wicks. So we're at really a very important level. I've just bought the S&P right now. My stop loss is beneath this low, just beneath here. I think it's at 37.80 or 37.75, which is here where the mouse cursor is at the moment. So, and I've just taken a very small position on this. So the same applies to this. We've had very poor inflation numbers coming out on Friday, which caused the market to drop. We've got the Fed details coming out in terms of interest rates and their comments, their projections going forward, which come out on Wednesday. So that's going to be the massive market mover this week. Once again, I don't want to get rid of that. Similar to the S&P, if we do manage to break beneath these lows, that's the bottom of this Fibonacci level, then there are all sorts of support levels beneath us. But we could see the S&P correcting down to 3,700, even 3,600, and more likely this level here. If I put a horizontal level in there, you'll see why. We don't want that. So if I put a line in there, you can see again that was the previous all-time high. We've got some support created by these two, this double bottom on these dips here, and that's at about 34,000. Possibly, if I move this slightly higher to the tops of these retracements, this resistance level, that would be 3,600. So this is the area to watch if we do break down beneath these levels. And well, this is what's called potential capitulation, maximum point of pain, I suppose you might want to call it as well. If the market breaks beneath these levels that we're currently at, there are going to be a lot of stop losses beneath here. The market's going to probably just tank, and the bulls will give up, the bears will take over the show, and we'll be heading down to that red line somewhere around there, maybe slightly above it, maybe slightly below it, but in that region. That's at about 3,400. There is one other possibility, of course, which I'm currently betting on with a small position, currently long at exactly this level. As the market hit that 78.6% fib, that's when I triggered my buy position. It's a very small position, and I'm willing to perhaps add a little bit more to that before we reach this low. So that's my current strategy. But the other possibility, of course, is that this will become a reversal candle. Notice that we have a shaven bottom candle here, which is actually a reversal pattern, believe it or not. You'll see often when we get shaven candles, meaning there's no real wick, and you can see there's no wick on the top or the bottom of this candle, very tiny wick at the bottom. You'll see the same on the NASDAQ. Basically a shaven candle, very, very little wick, so we closed at the lows of the market. A tiny little bounce there, but nothing significant. So these shaven candles can be reversal candles. So you see one there, it reversed significantly thereafter. This is not so much in stock markets, by the way, this shaven candle pattern, but sometimes it does occur. And you'll see there's a shaven bullish candle pattern against resistance. There's the resistance. This is a good example, in fact. Go, Siri. So we've got a shaven head candle there against resistance, and it reversed. And here we've got a shaven bottom candle against support. And it could be, and we'll find out very soon, in about, I don't know, 7 hours from now, the market's open, or pre-market, out of market trading, or out of, oops. Let me just remove that. Can't remember what they call it now. Anyway, the trading that takes place outside market hours, we could see this begin to edge up, and then moving into the Japanese and European sessions tomorrow, it'll be very interesting to see what happens. Now, the third scenario is, and this is also very possible, and you need to be very aware of this, watch out for false breaks. So I put my stop loss on this trade, and the same on the S&P, a fair number of pips beneath these previous lows, giving it a little bit of space, a little bit of a breather, because we could see a false break and then a sudden reversal and a V-shaped bottom on the smaller time frame charts, and see this market just make a false break beneath there, bounce back up, and then start to rally. So that's another potential scenario. And like me, many traders, big position holders, will have their stop losses a little bit below these lows, not just below them, but giving them a little bit of space in case of false breakouts. And as you'll know, if you've traded for a while, false breakouts happen fairly often in most markets. So the same goes here on the S&P. I put my stop loss at 37.75. It could even be 37.70 actually. I'll have to have a closer look. Anyway, it's some distance beneath this previous low. Not an awful long way, but giving it a little bit of breather in case of a false breakout lower. So that's a scenario for stock markets. Overall, I think probabilities or possibilities are bearish, given that simply looking at fundamentals, given the very high inflation rate numbers that came out on Friday, and the possibility that the Fed will increase interest rates by more than 0.5% on Wednesday, and followed by their comments thereafter, which are almost certain to be, I don't want to use the word fear-mongering, but they will monger fear. The Fed will be talking about inflation and how high it is, and how they need to be resilient and determined and resolute to make sure that inflation doesn't continue to rise any further. All right, so that's the stock markets. So my position, long, very cautiously, very tentatively, until we break beneath these previous lows, and by a little bit of a margin in case of false breakouts down. But it all depends on really the opening of the markets, the European session and the Asian session, which starts in a number of hours' time. Okay, so that's the stock markets. For those of you, I know a lot of you don't trade stocks, but I do. So I've got a very small long position on both of these. Stop losses beneath there. I might add just a little bit into this S&P position. And when I say small positions, I mean really small, just edging into the market. If we do see a reversal, then I'll actually begin to add to the long positions on rallies, particularly if we get above these resistance levels here from the previous week or two. So if we manage to break above there significantly and hold above there on daily close, I'll be adding to my long positions. I'm not prepared to add to long positions beneath these supports. Let's have a look at oil. Now, I don't have all the indicators on here, but if you put on a MACD or an RSI or a stochastic, you'll see that oil is actually, well, apart from being at incredibly high levels and causing the point of maximum pain in consumer markets, particularly the price of the gas pump all over the world. Let me see if I can just go out a little bit here. Might have to switch to a weekly chart. Let me just show you where we are on oil over the long term. So there we are. We're right up here on oil, up here, more or less at the highest level it's ever been, going back to 2010, so that's 12 years ago, and then further back to 2008. That's 14, 15 years ago. We're at that sort of level now. And we've got a very overextended chart move. We're way above the moving averages. You'll see that most of the indicators indicate an overbought situation, but they're also showing some divergence. I don't know if I may as well illustrate this to you, actually. If I just let's put on a stochastic. You're going to have to just bear with me. There's the stochastic. And I'm going to just change this to 1473 if you're interested in the settings that I use. These are the stochastic settings I use for for all charts really, currencies and stocks and commodities and metals. So what you can see here is we can see a stochastic divergence. In other words, the stochastic is not making higher highs. Let's see if we can just, you can see the stochastic is slightly angled downwards, whereas the price is angled upwards. Okay, so difficult to see on these charts actually. I wasn't going to put the stochastic on here, but it's difficult to see. Perhaps I can do this on a weekly chart. I'm just illustrating this to you, not specifically because of oil. There we go. Okay, that's a better example. So this is the same stochastic, 1473 on the weekly chart. You can see we're making consistently higher highs on the price, but on the stochastic, we're making lower highs, slightly lower highs, and right at the moment, the stochastic is way down. So we've got what you might term a divergence in the way that we've got a falling stochastic, but we've got a rising price. So what are we going to do about oil? If you're trading oil, I've had a look at oil, have had a look at gas, I've had a look at various other energy stocks and various things like Exxon and Shell and all those sorts of stocks and other oil companies. They're all showing a similar sort of situation where we've got rising prices but falling indicators showing divergence, and they're all at kind of extreme levels. Let's get rid of that. Go back to the daily chart. And if you're trading oil, I think if you look at all energy stocks, if you look at Brent crude oil as in itself, there's a good opportunity to sell. So I expect that we'll drop down to this very shallow but significant trend line here at about $106. And with a bit of luck, we'll drop down to this 200-period moving average, which is around about $95. It might be at about 98, somewhere around there by the time we drop down there. So we're at about 124 now. We could drop down to 100 or in the mid-90s. I think that's a good trade. So I'm in that one. Once again, it's a small position, but I've got my stop loss above this high here at 138, and I'm prepared to, and it's a very small position, I'm prepared to add in positions as we rise up towards this previous high in March, and the one prior to that we had a look at on the weekly chart. So if we do sort of spike up here a little bit, up to 130, maybe 131, 132, the top of these candle bodies, perhaps even right at the top there, I don't think so, but possibly, we have every chance of forming a double top. But at the moment, we've got some reversal candle looking like candles anyway here at this current level. This could be a false break above this previous resistance, which was over here. So I'm very tentatively short on oil. I have been for a while, as you will know if you've seen some of my videos prior to this. When it comes to currencies, let's have a look. First of all, dollar yen. Well, okay, this is a tricky one. In some ways, the dollar yen, the natural price for the dollar yen over decades is around about the 115 to 120 level, which is way down below us. You can see we're extremely overextended, well above all of the moving averages. That's the 20, that's the 50, that's the 200, miles and miles above. They're really overbought, and at something like all-time highs as well. Let's just see if we can have a look at the weekly chart and go back in time. And it's going to be a long time before we see. Okay, you can't see it on this chart here. Let's see if we can get it on a different, on FXCM. Perhaps they'll go back a little bit further. There we go. So you can see the last time we were at these sorts of levels was in 2002, so 20 years ago, and 1998, 24 years ago. And so it's not just the fact that we're incredibly overbought and we've moved up without pullbacks. You can see the dollar yen moves in a very zigzag sort of fashion mostly. Often because of intervention by the Bank of Japan to keep their currency weak. They'd be very happy with the way the currency's gone at the moment, being an export country. Not just because of the fact that we're at these extreme levels, but because we haven't seen any of the zigzag move. And in this last rally, we've had one small pullback, that's all, and we've moved right up to these levels. And we're definitely due for a correction on the dollar yen. So now keep all of these in mind together. So we've talked about stocks, we've talked about oil. If the oil price comes down, stock prices will go up. So bear that in mind. They work in conjunction in many ways. Now we're talking about currencies. When we talk about currencies, we always need to look at the dollar index. But let's just have a look at what's happening on a daily view on the dollar yen. Now, remember, this is the dollar yen. This is where candlestick charting kind of originated. So when you look at candles, you immediately think of Japan. They're called Japanese candlesticks. So whenever you look at the Japanese yen, look at the candlesticks. their market is kind of attuned to the way candlesticks work and the significance of candlesticks. Many of the names of the candlestick patterns are still Japanese names, like dojis and the Japanese words for spinning tops and gravestones and so on. And you can see right here, we've got two hanging man upside down gravestone doji candles, 2 in a row. This is the daily chart. So we've got 2 in a row. Those are both reversal patterns. The fact that we've got 2 in a row is interesting, perhaps even significant. At around this price, I'm short on the dollar yen. I'm hoping for a move back down into, well, at the very least, this level here, which is 131, the previous resistance there, and even further than that, with a bit of luck, down to around about 127, 126, 127, the most recent support. So that would be a big drop in the dollar yen. And once again, with these markets, bearing in mind the inflation and interest rate scenarios, the gas price, oil price, and so on, the uncertainty in the market, if you look at commentaries from various banks and analysts, and even, dare I say, various videos on YouTube, you'll see that there is opinion both ways in all of these markets. When it comes to the dollar, when it comes to oil, when it comes to the stock markets, there's a great deal of uncertainty. We're at that point, actually, of inflection, of potential capitulation or a serious reversal. And no one really knows what's going to happen. And it doesn't matter what people say. No one actually knows. So these are all just opinions. These are my opinions. I think it's still worth taking the contrarian view and shorting oil, shorting the dollar, buying the stock markets. We'll find out incredibly soon in the next week, literally this coming week, whether we're at a stock market bottom, whether oil has reached its peak, whether the dollar has reached its peak, and so on. We'll find out in this coming week with the news coming out on Wednesday from the Fed. So that's the dollar yen. So you've seen those 4 charts. I'm very tentatively long on both these indexes, the NASDAQ, the S&P, but willing to add a little bit more to the S&P if we drop a bit further down towards this low, not on the NASDAQ, but on the S&P, and stop losses beneath both of these previous lows with a move down even further. It could be quite a significant move down if we do break beneath there. Oil, I'm short. Very tentatively, I'm willing to add a little bit more to these short positions. If we move slightly higher, my stop loss will be above that previous high. Same with the dollar yen. I'm not going to average into this position. I'm going to be short here. I've got a very, very small stop loss. As you can see, that's the beauty of these candles. If you have a look at my candlestick video, you'll see why I favor these types of candles. Shaven head type candles and doji candles without long wicks at the top or the bottom. In other words, gravestone or hanging man dojis, as these ones are called, because you can get into the trade with a very small stop loss. So I'm currently short with a reasonable size position, but I'm able to keep my stop loss very tight, because the moment we move above these levels, the tops of these 3 candles, and they're all precisely the same. We've got 2 reversal candles in a row. I can get into the market with a very tiny stop loss, very small stop loss, with a reasonable size position. So this one, I'm willing to throw a bit more money at it than the other ones. These ones I'm just edging into. This one, well, I'm either right or I'm wrong. If I'm wrong, it's no train smash, because it's a small stop loss, and we'll find out very quickly. Right, now, I wanted to have a look at, first of all, we're going to talk about the euro and the pound. But before I do that, I'm going to have a look at the dollar index, because this will inform a lot of what I've got to say regarding those currencies. So let me try and find the dollar index on here. Just going to pause this for 1 second. Okay, so here we have the dollar index. Now, this is a really interesting chart. And we're at 104 right now, 104.2. And if I have a look at the dollar index over time, I'm going to switch this to a weekly chart just to give some perspective to what's going on. If you look back to 2000 and beyond, even 1986 and so on, you can see the dollar index was really, really high. At one stage at about 160, over here at 120. But in more recent times, we've got this pattern here. And you can see that we've got highs. Let me just put a horizontal line in here. We've got highs going back to 2017 at around 103.80, just about there, that red line. And you can see we broke up above there a few weeks ago. We didn't manage to hold it. We had a reversal, a big bearish engulfing candle, another bearish candle, and we're back up to these levels again, just above this 103.8 level, but below the recent highs of the dollar index. So this area here is a very significant area. That's what I'm trying to say. If we go back to the daily chart on the dollar index, you can see I've got a Fibonacci level drawn in here. And from that recent high, actually, I think I could be a little bit more precise. From that recent high, going back to May, so about a month ago, middle of last month, down to this low at the end of last month, and back up to where we are at the moment, you can see we've retraced again, very similar to the stock markets, exactly 78.6%. And on top of that, we've got a shaven head candle. And overall, we're at this red line, which I drew in from the weekly charts, this very significant level over here, which has been previous resistance. It was resistance here for a bit. We closed above it for a while, just a few days, broke significantly back beneath it. We've come back up to that level. We've closed above it on the daily chart, and that's where we are at the moment. So what does this mean about the dollar index? And the reason I'm talking about the dollar index, remember, if you're not familiar with the dollar index, it's it's an index based on a basket of different currencies against the US dollar. So it indicates the overall situation with the dollar against various currencies. So it might be tradable actually with some brokerages. I'm not sure. I've never traded the dollar index itself. I trade the individual currencies. But if you were trading the dollar index by itself, if you were, if I was, I would be looking to short this right now at this current price, 104.20, because I think that once again we've reached a very crucial tipping point on the dollar, as we have on stocks, as we have on oil, as we have on a variety of different things, even commodities like wheat and corn. They're all at very interesting levels. And I would say overall across all markets, we're at the point of maximum pain, which means simply this is where people really start to squirrel and feel uncomfortable with the current prices, and it starts to affect them in very significant manners. When it comes to inflation, we're at the point of maximum pain. Gas prices at the pump, food prices, everything is incredibly uncomfortable at the moment. And for those who are trading the stock markets, these corrections have become almost unbearable. So what happens at the point of maximum pain? Well, we either get one or two things. We get capitulation, all the longs, all the bulls give up completely, and the bears take over, the market collapses. And we'll see oil go through the roof. We'll see the stock markets collapse. we'll see the dollar continue to rally. We'll see the euro and the pound continue to decrease. So we're at that point. And actually next week, this coming week, given that we've already had the very poor inflation news, CPI news on Friday, this coming week, Wednesday, will be probably the deciding factor as to which way we go. Are we going to completely give up? Oil through the roof, stock through the roof, downwards rather, not through the roof, through the floor, and commodity prices, inflation, interest rates, and a lot of it on Wednesday depends not only on the interest rate announcement. Bear in mind that it will be at least 0.5%, almost certainly. It could be even higher. It could be 0.75, which will be disaster for all of these markets. But let's hope that sanity prevails and it won't go to 0.75. But as equally as important as the actual number are going to be the comments which follow the number and things that the Fed says about all of this going on. Dollar index, again, very similar to the NASDAQ and S&P. I would be willing, if I was trading this, which I'm not, I don't know if you can even, I'd be willing to short this at current levels at the 78.6% fib, given that we've got a shaven head candle, low risk because of a small stop, because of there's no big wick on this candle, so we could keep our stop losses fairly tight on here. Or if you wanted to take a slightly more considered view on it, you might want to put your stops above this level here, above this recent high, but go in with a smaller position. Alternatively, going with a bigger position, much tighter stops above the current level at 104.2. Right, so how does that affect the euro and the pound? This is probably what you've all been waiting for, so let's go across to the euro. And here we are on the euro, and I've got the same thing drawn in here. Well, all of those dots down at the bottom there are these things that are coming up next week. We've got the ECB, some comments on there, balance and trade, this is on the 15th, and then somewhere along here on the US side, FOMC, there we go, on the 15th, 8:30 my time, so that's just after lunch, New York time, Eastern time. Interest rate decision, forecast is 1.5%, so that's 0.5% up. And then we've got the press conference thereafter. Half an hour later, that's going to be where possibly even bigger news than the actual rate is going to come out. If that rate stays at 0.5% increase, depends on what they say thereafter, half an hour later, regarding what they think is going to happen going forward. Let's have a look at the chart. Euro, US dollar. Look where we are. We're at the 61.8% Fibonacci level. Again, we've got this shaven bottom candle. We did have a small bounce back off there. We're at significant support over here, this level of consolidation and support at exactly where we are at the moment. Once again, I'm going to have to say I'm going to be bullish on the euro, and I'm really hanging my hat on this stand at the moment until I'm wrong, which I very well could be. And these are very difficult trades to take because all things point to a stronger dollar, a weaker euro, a weaker pound, weaker stock market, higher oil prices, a stronger dollar yen. Everything points to that, not only on the charts, but also given the news that has come out on Friday and is going to come out on Wednesday. Particularly the press conference, bear that in mind, not just the number on Wednesday. Once again, opportunity for a small, long position. This is the way I'm going to play the euro. I'm going long here right now. I'm actually already long. I got in at near the close of the market on Friday, and I've got a very tiny position. I've got another position to buy here at the 78.6% fib, and my stop losses will be, in fact, I think at 1.039, which is just about here. So if we break beneath there, just around there. So that's beneath all of this support. It's beneath the 78.6. and I'll be taking very small positions here. Now, a lot of you might be saying, well, why aren't you trading this short? Well, I've explained to you why I think that we're at this point of inflection, change, maximum point of pain in the market, and we will either be going up or we'll be going down, but it's going to be determined in a large part by what happens on Wednesday. I think what's going to happen is we're not going to see a lot of action until Wednesday, and we'll probably see some small retracements no matter what. Particularly in the next few sessions, we'll see the market just begin to edge up. We'll see stocks begin to edge up. We'll see the euro and the pound begin to edge up. Perhaps oil. Oil is actually going to be very interesting, because if the oil price really tanks, it's going to help the cause for those who are long on the stock markets and long on the euro and the pound. So we'll be keeping a very, very close eye on the oil price, not just because I'm short on the oil price, on Brent crude oil, but because it's going to affect how all these other markets react as well. So long position here at the 61.8% fib, adding to it at the 78.6 at about 1045, slightly above there. That's at 1044.50, call it 1044. My actual ordering, I'm going to be long again at 1045. My stop losses just beneath here, giving it a little bit of room for breathing room as well. So that's the euro. Now, if I'm wrong on all of these and I get stopped out, these are not going to be big losses at all. I'm not hanging my hat on that this is going to be the correct direction that I've chosen. But it is a contrarian position, which I often prefer. And when you look at the news and you hear everyone talking about the doom and the gloom in the markets and the strength of the dollar and the oil prices going through the roof, when you read all of that and hear about it all, by the time you start hearing about it on the news, it means that the market's already deciding to go the other way. That's very often the case. Not always, but very often. So that's the euro. Pound, even more interesting, really. So this is the pound against the dollar. We've broken through the 61.8% fib. We're heading down towards the 78.6. My order is in there to buy at, I think it's at 22.50. Bear in mind, when you set orders or you look to trade off orders, it's always a very good idea to trade off sort of roundish numbers. They're natural price magnets. So rather than go for 22.40 or 22.60, I always prefer to go for, the 50s, the 100s, and then the 80s are also interesting numbers, so 80s and 20s. So if you're ever in doubt, choose an 80 or a 20 or a 50 or a round number, the zeros. So over here, my order is at 22.50. Not only because it's a half round number, but it's also the previous lows of these bodies here, right at 22.50. If I'm wrong, my stop loss is going to be beneath the 78.6%, just a few pips below my entry price. Doesn't really matter. And we'll certainly see the pound then testing these lows again and potentially moving lower. So it depends what happens with the dollar index. If the dollar is going to continue to rally, let's go back there and have another quick look, just to remind you. There's the dollar index at very high levels historically. There we go. So it's a sort of a triple top, really. There's the previous attempt in 2016, another attempt in 2020, and now in 2022 we're back at the same sort of levels. We are worryingly slightly above it. We have closed above that resistance line, which is not the best scenario, but we are at the 78.6%. This is the dollar index, remember. We are at the 78.6. We are at all-time, not all-time, but recent history significant highs. We do have a shaven head. We can get in with a very small stop loss for low risk. So that has informed my choices on the euro and the pound. And so my position really is short the dollar overall, but with small positions, low risk, tight stop losses in the case of currencies. And just to remind you about the dollar yen, this one I particularly like. 2 doji hanging man candles at very high levels, very, very overbought, no pullbacks apart from this little one here. Given the general nature of the dollar yen chart patterns, you can see it's always very zigzaggy. That's just the way you get to know the nature and the personality of currencies if you've been trading them for long enough. We always see zigzaggy sorts of patterns in the dollar yen. You can go back as far as you want, you'll see it's always like that. There you go, you can see zigzags everywhere you look on the short term time frames and also on the longer time frames. But this last move up, no zigzags. So we should at least sag back down a little bit. 2 reversal candles, very tight stop loss, in line with my thinking on stocks, on the dollar index, on oil, and so on. So I hope you found that useful. So I've given you my overall strategy, and these are tricky times. Please, if you do anything in the markets, if you could just decide to stand aside and stay out, you might be missing a few opportunities. Don't fall prey to FOMO, fear of missing out. There's no need to be in the markets right now if you don't want to be, and particularly not if you're not willing to take some small losses. But don't be prepared to take big losses, because whichever way these markets go, they're going to go suddenly, aggressively, violently, and with some capitulation, whichever way they go. So don't get stuck into positions either way. It's not worth it. There'll always be opportunities to get back into the market. Rather take the small stops, take the little tap on the chin, no problem at all. My total risk on all of these trades that I've mentioned now, so I'm in 6 different things. I'm in 2 stock indices, NASDAQ, S&P. I'm in oil. I'm in dollar yen. I'm in euro and the pound. What else am I in? So it's oil, NASDAQ. So 3 currencies, euro, pound, yen, and NASDAQ, S&P, and oil. So that's 6 that I'm in, all in roughly the same direction. They do move, of course, differently. They don't move in symphony with each other perfectly. So there's a little bit of hedging involved there, but not very much in this case. But my total risk on all of these trades is less than 3%. I think it's actually slightly less than 4%, 3.3%, something like that. And if that's what happens, if I'm wrong and I get stopped out, that's all I've lost. If I win and I'm correct, I stand to gain a lot more than 3%, probably more in the region of 10 or 11 or 12%. One more thing I just wanted to point out while we're here, and I said I'd, actually maybe I didn't say I'd talk about it, but I might as well, is Bitcoin. And as you know, I don't often trade Bitcoin, but this is quite remarkable. For those of you who are coin heads, or whatever you call it, Bitcoin's a bit of a meme currency in many ways, so bear that in mind. If you don't know what a meme stock is, or a meme, M-E-M-E, go and look it up. But essentially, these are instruments that are greatly influenced and manipulated almost by social media and public memes, sometimes spread about by nefarious characters, I have to say. But bear that in mind. Look at how tightly consolidated we've been on Bitcoin, going back all the way to the 11th of May. So more than a month, or let's say exactly a month, we've been stuck in a range between 31.5 and 2,800, something in that region. Now I'm long on this at 29,700. So we're at 29,200. Once again, I've got a small position here. I've just put some Bitcoin into my wallet. I'm not trading this into my Luno wallet. I'm not trading it actively as a day trader. I've just put some money in there. I'm willing to lose half of it, but if it does rally, I'll make a good profit on it. So how does it look at the moment? I don't know. I don't think it's looking particularly good, actually. I think it's looking a bit bearish, and I think we might get one or two things happening. Again, Bitcoin moves in sympathy very often with the US stock market, so some of it depends on what's going to happen in the stock markets this coming week. But very similar to everything, we're at a sort of a tipping point, and for those of you heavily invested in Bitcoin, I know this is going to be incredibly painful if it drops. If it does drop, we're going down to 20,000. There's no doubt about that, unless we get some sort of weird false break. But I don't think that's going to be the case. 20,000 is where we'll be headed, and possibly even down to 14,000. So if I copy that line, clone that one, and just drag it down, there's the next support level. So it's actually 13.5, and that's possibly even a better support level than the 20,000 level. So this level here, we've got that level there, 20,000, 13.5. We're at 29,000 now. If we do break down, there's going to be a lot of pain in the crypto market, I'm afraid. It's going to be unpleasant. And if we drop down to 13.5, well, that's, yeah, nasty. Very nasty indeed. That's another, another halving of the price of Bitcoin and more. So, but for the moment, as long as we hold above 2,800, this red line, and then 2,500, 25,500, this previous spike low, as long as we hold above there, we should be in line for a nice rally on Bitcoin. But we've tested this resistance a number of times. Once, twice, 3, 4, 5, 6 times, and failed every time. We've only tested the support once or twice, maybe 3 times. So we've had much more of an attempt at the resistance level, about double the number of attempts at breaking up, and failed every time. We haven't tested the bottom again for a while. And overall, it's just looking like we're not going to get that breakup. And so 20,000 and then 13.5 lies beneath us. And there's nothing in the way of that fall, I'm afraid. We've got open charts beneath us, big open space. This whole area here is absolutely no support whatsoever. And until we get to 20,000. If that doesn't hold, 13.5. Call it 13, or 13.5, 13. So, but this area here is just a big, wide open, supportless, bleak, barren area. And if Bitcoin gets through that last spike low, well, there's a long way down before the next support. So that's Bitcoin. I'm very, very, very cautiously still in this. I've bought Bitcoin, so but I'm fully aware that it's incredibly risky, and unless the markets turn around this week, we're going to see Bitcoin fall. And again, a lot of this is going to depend on the Fed on Wednesday, I'm afraid. So we're all in the hands of the Fed. Another thing quickly just to reiterate on Bitcoin, unfortunately, again, we see for the bearish scenario, we see this head and shoulders pattern, left shoulder, head, not much of a head, but it is above the left-hand shoulder, right-hand shoulder, and we're dropping down to this neckline here. And if we complete this pattern, well, we'll be going down to 13,000 to complete this larger head and shoulders pattern. The way I look at it right now, that looks like the most likely scenario. But I'm holding out for the longs. We'll see what happens. Okay, well, that's that. Well, not very good news for those who are market bulls and euro and pound bulls, I'm afraid. But there's still some hope, not an awful lot, but some hope. And if you're a day trader or a swing trader, it's still worth trying. but bearing in mind that you need to keep small positions and tight stops and be careful and aware that the market may very, very well move suddenly against you if you're in those sorts of positions, and you need to make sure that you honor your stop losses, don't move them, don't be tempted to hold on to falling trades, falling markets, and you can always get back in later on when there's another opportunity to buy if you're determined to go in that direction. Alternatively, you could sell right now if you want to take the bearish stance on coin, on the euro, on the pound, on the stock markets. If you want to take the bearish stance, you could do that as well. I think it's, like I say, keep on saying, we're at the point of maximum pain, point of inflection, decision point, capitulation point, and whichever way we go, it's going to be dramatic, it's going to be quick, it's going to be sudden, it's going to be severe, and whichever way you've decided to trade, make sure that your stops are in and that you're not risking an awful lot on any trades that you take. Good luck for next week, and I'll check in with you as the week goes on, particularly after Wednesday or leading up to Wednesday.